All right, let's talk about something that so many families struggle with. You know the feeling, right? You're trying to figure out long-term care for a parent or a relative in their 80s, and it just feels impossible. Like you've missed the boat and every door is slamming shut. It's frustrating. And honestly, it's one of the most misunderstood parts of planning for retirement. But what if I told you the whole way we're looking at this is just wrong? So, this is the million-dollar question, isn't it? Is it even possible to get long-term care insurance after 80? I think for most of us, the immediate answer in our head is a big, fat nope. We just assume that window has closed for good. But is that really the case? Well, it turns out that's one of the biggest myths out there. The problem isn't that there are no options, not at all. The real problem is that most people are trying to use the wrong tools for the job. They're looking for a traditional insurance policy when the answer is actually a completely different strategy, one that uses the assets you already have. Okay, so to really get the solution, we've got to talk about a hidden problem first. Lots of retirees have this just-in-case money, right? It might be sitting in an old deferred annuity or some other conservative account. And they think, great, that's our safety net. But what they don't see is the giant tax trap waiting inside it. And this quote just nails it. Think about an annuity that's been sitting there for, say, 20 years, just growing and growing. Now, all of a sudden, you need that cash for at-home care or a nursing facility. Well, guess who gets paid first? The IRS. They treat all those gains as ordinary income, and they take their slice right off the top. So here's how that old-school approach plays out, and it's not pretty. Step 1, a health crisis hits, and you need money for care. Step 2, you pull the money from that old annuity. Step 3, bam, you get hit with a big tax bill on all the growth. And the bottom line, step 4, is that there's way less money left over for the very thing you needed it for, the care itself. Oh, and it gets worse. It's not just that one tax bill. Pulling out a big chunk of money like that creates this nasty ripple effect across your finances. It can spike your income high enough that suddenly more of your Social Security benefits become taxable, and it can even push you into a higher bracket for your Medicare premiums. It's like a financial triple whammy, all from one decision. Okay, so that's the mess. Let's talk about the elegant solution. It's a strategy called asset repositioning. And the key idea here is to forget about finding new money to pay for some massive insurance premium. This is all about making the money you already have work a whole lot smarter. The hero of this story is a special tool that was created thanks to the Pension Protection Act, or PPA. A PPA-compliant annuity is basically a hybrid product. It's designed to do one thing incredibly well: let you take the gains from your annuity and use them to pay for qualified long-term care expenses, completely, and I mean completely, income tax-free. So how do you get your money from the old, inefficient annuity into this new, super efficient one? You use something called a 1035 exchange. This is a neat little section of the tax code that lets you do a direct transfer from one annuity to another, without cashing out and, more importantly, without triggering any taxes. You're just moving your money from your left pocket to your right pocket. Now, this is where the magic really happens, because when you reposition your assets this way, you unlock two incredibly powerful benefits. The first is getting that money out tax-free for care, and the second, leverage. Let's just put these two options side by side. The difference is, well, it's night and day. The old way, you cash out, your gains get taxed, you get no leverage, and you might leave a tax headache for your kids. The new way, withdrawals for care are tax-free, your benefit gets multiplied, and if you end up not needing the care, there's still money left for your heirs. It's a no-brainer. So let's talk a little more about that leverage. What do we mean when we say the benefit is multiplied? We're talking about taking your initial pile of money and turning it into a pool of long-term care benefits that's 3 times bigger, sometimes even more. Let's make this real. Imagine you have a $100,000 annuity. If you just cash it out, maybe you're left with $75,000 after taxes for care. But if you reposition that same $100,000 into a PPA annuity, it could create a tax-free benefit pool of $300,000 or even more, all earmarked for long-term care. That's the power of leverage. It's a game changer. So, right about now, you're probably asking, okay, who can actually do this? Is this for everybody? Well, the qualifications are pretty specific, but the good news is they open a door for a whole lot of folks who thought every door was already locked. The sweet spot here is typically for someone between 80 and 87. Now, the absolute key, and this is non-negotiable, is that they have to be functionally independent. That just means they can handle their daily activities and aren't getting long-term care right now.
And of course, they need to have that just-in-case money we've been talking about.
And you have to understand, this is all about timing. The best time to act is between 80 and 85, when you'll get the best benefit multipliers. You might still find options at 86 or 87, but the leverage starts to go down. And the hard stop? It's the moment care is actually needed. Once that happens, it's too late. The planning window has closed.
So, let's wrap this all up. If there's one thing you take away from all this, what should it be? It's all about learning to see your nest egg, that just-in-case money, in a totally new light.
The goal here isn't to buy insurance. The goal is to perform a kind of financial alchemy. You're taking an asset that's really just a ticking tax time bomb, and you're transforming it into a powerful, leveraged, and tax-free solution for one of the biggest financial worries in life. And that really leaves us with the final question you need to ask, for yourself or for someone you love. When you look at that money you have set aside, do you see a tax problem just waiting to happen? Or do you now see the raw materials for an incredibly smart care solution? Because how you answer that question, well, it could change everything.